Hey traders, Clifford back with another video on trading the charts. So today I wanted to go over what I believe are three of the best profit taking and protecting risk strategies that I've found over the years. And it applies to all markets. So with that being said, let's rock and roll. Okay. So, you know, it's kind of like we can all find great entries to trading, right? Whether you're trading stocks, commodities, forex, futures, whatever. It, it's always, not too hard usually to find a good entry signal, whether you're using indicators or not. I don't particularly believe in indicators. I'll go over why in a moment, but I used to when I first started. But is it really the entry that's important? No. In my opinion, the most important thing is the exit strategy. How are we going to make a profit on our investment, on our trade, on our day trade, swing trade, whatever, right? So the key, of course, is profit taking. And if you have a great entry, but you don't have a really, strong exit strategy, it's kind of like, you know, you're kind of like up the creek there, in my opinion. Um, so exiting the market is the most important thing. And the truth is you can't lose by taking profits, no matter how small, no matter how large. Um, so, there's many different types of exit strategies out there. Lots of traders have different opinions. So I'm just going to share two that I found over the years that really have worked uh, good for me in the long term. And I've learned to notice price action a lot with them. So the first thing I'll say is if you're trading futures or Forex and you're using a stop loss, you we'll go over that in another video, but that's the first thing. Of course, like moving your stop to break even is important too. But we're not going to talk about how to protect yourself from risk. We're just going to talk about the exit. So let's get into it. So I use the daily charts, and again, I don't use indicators. I don't believe you need them. All you need to really do is look at the price. Price action is king. Support and resistance is king, in my opinion. So the first exit strategy we're going to talk about is support and resistance. And that's all you need. I know it sounds simple. It's almost like too simple. It's almost like it's like stupid. It's like, keep it like K.I.S.S, whatever, keep it simple, stupid, like that old saying goes. But it's true. It really is that simple. Support and resistance is all you need to exit a trade. And I'm going to show you how right now. I use the daily charts. I've said that many times because I believe the daily charts really shows you the long-term view of the market and where the true support and resistance levels are. Also, you want to watch the weekly charts, in my opinion. So let's say we entered a trade on the daily chart. Um, I don't know, maybe maybe right here. We got lucky. We entered at the bottom, right? This is the S&P. You just were an awesome strategist, and you just got in right at the bottom. I mean, you just killed it. You entered at the perfect time. So, where do you exit? Now, if you're using indicators, you might look at an indicator and say, okay, I'll get out when my indicator does a cross or something. You don't need all that, in my opinion. What you need to do, in my opinion, is just look for the most significant support and resistance levels. Now, if I enter here, I look at the past. I see the market had some strong resistance up here because it reversed all the way back down. So what would I do? So now there's actually three rules that I go by when approaching support and resistance. So as the market moves closer to a significant support and resistance level, the market can actually do three things. Um, and I learned this through many of books and courses I took over the years. So basically, the market can pause, meaning like it approach. So let's say this is the resistance level we're watching right here. What is this? 42.39, right? Because the market hit that level, reversed all the way back down. You got in at the bottom, and now we're getting close to 42.39. So what can the market do? Well, number one, it could pause, meaning it just doesn't do anything. It just kind of just approaches it, but it just kind of consolidates around it, like we see here. The second thing the market could do is reverse. And you see how here, when you got close to resistance, that level right there, 42.39, the market completely reversed direction. That's the second thing it could do. And then finally, the third thing it could do is it could just smash right through the resistance level like it did here. See, it smashed up and so on and so on. So three things the market could do: pause, reverse, or break through. And if it's a real breakout, you're you're going to try and write it out or whatever, right? Okay. So where do you exit? It's so simple, you're not going to believe it. Right at resistance. Because you know the market can pause, reverse, or break through, you don't even need to really worry about those things. In my opinion, if you know the market is probably, and another thing the market does, it almost always, before pausing, reversing, or breaking through, will test the level. See how it tested it right here at this candle? All you got to do is put your limit order right at resistance. I know it sounds so simple, right? There's no indicators. It's just like, that's it. Just exit at resistance. Yes, that's it. And honestly, you got in, you exited at the perfect price. Look what happened. You got out right at the top before it came back down. Let's look at another example. Um, what's another one here? Okay, here's the bond market, right? This is the, what is it, the 2-year note? I watch this one sometimes too. All right, so looking at a chart, where can I see a significant support and resistance level? Well, in my opinion, just looking at this chart, I see one right here. Look at what happened when the market hit this level, 10109. Freaking took off like a rocket ship. So in my opinion, if anything approaches that level, you want to either get out, or you want to at least protect some profits, which we'll talk about in the second strategy in a moment. And look what happened. The market just a few, what is this? Okay, last month, look at what happened. The market, as it started to approach this level, what do we say? Pause, reverse, or break through. Well, look at what happened. It not only reversed at that level, but if you let's say, I don't know, let's say you shorted, I don't know, maybe you went short somewhere here, your indicator told you to, or your one of your strategies told you to go short here, and you're selling these bonds, and then all of a sudden the market approaches that level, and you got your limit order there, boom, you got out right at the bottom. I mean, it's a beautiful thing. It really is, to get out at the perfect, literally the perfect place to exit the market. Um, what's another example? I don't know. What's this? Bitcoin? Can we find an example here, maybe? Uh, we'll do one more. Yeah. Bitcoin really doesn't. Let's see. Look at gold, maybe. Uh, or oil. Let me see. Okay, so here's one. This is oil right now. This is like crude oil. It was at 80, the resistance level, very significant, $83. And now you see what happened? As it approached, it's kind of pausing. It almost reversed here. So look, you could have got out right there. Let's say, I don't know, you went long somewhere down here, and you're writing it up. Boom, you get out right there. And that's it. So whether you're long, you place your order to sell at resistance. If you're short, you place your order to buy back at support. So that's the first strategy. And then the second strategy is a little different. This one allows you to actually be able to try and catch longer moves that might actually break through support and resistance. And this one I actually learned from a book also. I think it was called the three daily bar close profit taking strategy, um, by one analyst that I was reading about. So I think it was Bill Polis or one of those guys. But anyways, so this one's a little different. So basically, when you enter the market here, let's say you entered here, what you do is you look at the last 3 days. So you count 3 days forward. And let's say, now this one deals with like a stop loss. This is more for like Forex trading or futures, or I guess it could be applied to stocks too, whatever you're trading. But so you bought in here, and what you do is you put your reversal order right underneath support which is, let me draw it out here. So like right around, let me change this real quick. Let's use maybe red to make it more. Okay, so yeah, you bought in this candle right here, this blue one, and you have your stop loss behind that candle. Then you count 3 days forward, 1, 2, 3, and you just leave it behind this candle right here. And then as the market moves, so like then here it's 3 days before, you count three ahead again, and you see I move the stop up here. Leave it 1, 2, 3, move the stop up here, and you just keep doing that. 1, 2, 3, count three, move the stop behind behind 3 days. Basically, you're staying 3 days behind the market. So like here, 1, 2, 3, you will move the stop here. Up here, 1, 2, 3, you would move the stop up here, and eventually, 1, 2, 3, or sorry, 1, 2, 3, and then you move the stop up here, and eventually you're gonna get stopped out. But a lot of times, this strategy can help you catch long moves in a trending market. So like a trending market is maybe uh what's a good example now of a trending market? I guess we could use the bonds again. So like see if you want to, so like I mean I think support and resistance is still the best strategy, but I don't know, let's say you were in a trending market like something like this, it really pays off because you got 3 bars behind, 3 bars behind, 3 bars behind, and you catch, sometimes you could catch a really long, large move in a trending market. So, so that's the second strategy that I have also used, and it can be very successful also. But in my opinion, the support and resistance is even better because the thing is with the 3 day close strategy, and you stay 3 days behind the market. I was looking at another example. Any other markets here that are trending right now that I can show an example, but okay, like here maybe. So like you see 3 days behind the market. So you put your stop loss back here. Let's say you entered on this candle, maybe you got lucky, you got entered at the bottom, and then you're just moving it up 3 days. Count three, 1, 2, 3, and then you move it up to the next. Stay behind again. Just stay behind the market. 3 days behind the last candle of the market. So you count three, 1, 2, 3, move it here. 1, 2, 3, move it here, and then you see how most of the time 1, 2, 3. You're still kind of behind this candle, even though the market almost stopped you out. You didn't get stopped out because you stayed 3 days behind the market. That was his rule in the book I read, and a lot of times it can catch you a very significant move also. But again, I still like support and resistance the most because a lot of times support and resistance will truly get you in finding the top or the bottom a lot of times. Not all the times, but definitely a lot of times it can. So I hope that helps some who may have been wondering the best place to exit a trade. Again, in my opinion, the exit is the most important thing in all of our trading because I mean we could have a great entry, but if we don't have a good exit strategy and use discipline in where to exit, we could see those profits that we have open just reverse and become either losses or break evens or whatever. So that's a good rule of thumb for those two strategies. If you like the video, feel free to like, subscribe, put your comments below. Look forward to seeing you guys in the next one. And as always, my friends, trade what you see on the charts. Trade well.